Welcome to today's presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals, albeit we have to mention here that the fundamentals are pretty low. There's not much here to say. Should you have any trading instruments you would like to have a look at, let us know in the comment section. If we have time, definitely we'll have a look at them. If not, we'll make some space tomorrow. Now, in front of our screens, now we have Euro USD's daily chart. Allow me to reposition the label slightly. Now, today we have a downward motion, which seems to be pretty intense. I would be highlighting here that mostly that may be more of a strengthening of the US dollar rather than the weakness of the euro. However, let's have a look at that. And to do that, I would like to have a look also at USD/JPY, which should be on the rise. It's not. Let's have a look at GBP/USD, also falling. USD/CHF, rising. So practically the only exception in the strengthening of the US dollar among these four pairs we have just witnessed would be USD/JPY, which is dropping, and that seems to be more of a JPY strength than anything else. Now back to Euro USD's daily chart. The correction high yesterday and the intensification of the downward motion today, in my opinion, tends to highlight the bearish outlook for the pair. On the other hand, though, I have to note here that the price action of the RSI indicator, despite correcting lower, is still above the reading of 50, maybe implying that, okay, on the one hand, the bullish sentiment is fading away. On the other hand, though, the bearish sentiment is still to come. If we drill into the 1 hour chart, then you can see how the pair dropped, stabilized, drops again, back to the 4 hour chart, becomes even more obvious, and allows us also to draw a downward trend line. Moving to the daily chart, could widen it, keep it right there. However, that's too fresh. I would require actually for the downward trend line to be valid more lower peaks and lower truths, as just one touch may not be convincing as such. Overall, though, we do see the case for the pair to drop, yet to do that, the pair has to breach below the S1 1.0860 and start aiming for the S2 1.0815. I think that a possible breach of the S1 would be a more obvious signal of the pair's bearish tendencies. On the other hand, should the pair bounce on the S1 1.0860, that could imply more or less the possibility of a sideways motion. And such a sideways motion could be confined between the S1 1.0860 and the R1 1.0915. For a bullish outlook, the bar is pretty high. It's a very remote scenario right now. And for a bullish outlook, we would require the pair to reverse direction, breach the R1 1.0915, and actually form a higher peak than this one. So the price action has to start aiming, if not reaching, the R2 1.0980, a level which provided resistance. Right here, it was very nicely how the intense upward motion was reversed in a V-shaped movement. Let's have a look at USD/JPY. Before that, you know what? Let's have a look if we had any comments from ECB Chief Strategist Lane. Okay. Okay, the speech has been released as such, and I'm not going to go through that whole thing right now. It takes some time. Okay. Overall, there seems to be little comments about monetary policy. Yeah, I don't think we had any major impact on that. Let's drill into the 1 minute chart and unlock it. He was speaking about here. There was no major movement, but overall afterwards the pair dropped. Okay. Back to the daily chart, readjusting. Once again, we tend to maintain a bearish, I wouldn't say outlook, more of a bias or predisposition. Yet once again, for the bearish outlook to be confirmed, we would require the pair to breach the S1 1.860. Moving now to USD/JPY, which dropped. Once again, I'm going to be drilling into the 1 minute chart for any abnormal movements. And okay, this is interesting. See how the pair dropped once, then twice. There are some steep movements here. Now, whether that's a market intervention by BOJ or not remains doubtful. It's not so clear-cut as previous market interventions by the Central Bank of Japan. But definitely, it's a little bit abnormal for the US dollar to losing ground against the JPY in the moment that it's gaining against, say, for example, the euro and the pound. Also, let's have a look at the USD CAD. It's also gaining. However, that's expected given the possible weakening of the Canadian dollar ahead of BOC's interest rate decision tomorrow when it's expected to cut rates. AUD USD also losing ground, so the US dollar is gaining here as well. So once again, among majors, the only exception where the US dollar is losing ground is USD/JPY. The RSI indicator is nearing the reading of 30, implying more or less an intensification of the bearish sentiment among market participants for the pair. Should the bears maintain control, we may see the price action of the pair actually breaching the S154.60 and start aiming for the S251.85. However, there is some doubt here about the bearish outlook of the pair, and that's due to the fact that the price action seems to have some difficulty in forming lower trows. And I'm noting this because if we drill into the 4-hour chart, you can see how the price action was falling, hitting a low point right here. Now, given that we had a higher trough, then a lower trough, then the next trough should be even lower, somewhere around the S1, maybe even lower. But for the time being, that level has not been reached. So there seems to be some difficulty on behalf of the pair to form lower troughs. Should that not be overcome, then the bearish outlook may turn into a sideways motion, initially at least, between the S1 154.60 and the R1 157.54. Back to the daily chart. Also, I would be noting that the price action, you can see that in the daily chart, how the price action breached the lower Bollinger Band and corrected higher. And now it's nearing the lower Bollinger Band once again. So that could slow down the bear somewhat. Once again, I'm highlighting the possibility of a bearish outlook, but I'm issuing also a warning about a possible stabilization of the pair. For a bullish outlook, the pair has to breach the downward trend line guiding it. That would be a first signal that the downward motion has been interrupted. Yet that leave the further direction of the pair as rather ambiguous. For a bullish outlook, we would require the pair to also breach the R157.54, a level which provided resistance here, was tested again here, that was on Friday, and then start aiming for the 160.20. There's a request to check on USDCNH. Give me a sec. Byte USDCNH is heavily regulated by PBOC. Let's have a look. Sorry about that. Here it is. Now let's open a new window. Daily chart. Candlesticks. Zooming in. Has been on the rise in the long term. And that's a heavy, heavy upward trend line. And I would be adding, let's color the trend the trend line in white. Now the price action has hit a high at this level. And at this point, I'm going to be drilling out, reallocating one upward, second resistance line, third resistance line. Let's add also some support lines. Definitely this true here is very interesting. In green. Let's put it in lime green. Second support line, I'm placing it at this true. Could go a bit lower. There are also some attempts to reach it on the rise. And the third one right here. It's a little bit uneven, but to tell you the truth, I don't care about evenness right now. My main event, my main purpose is to actually hit shows and peaks. So you have conflicting messages here. On the one hand, on the long term, let me add some labels as well. Starting with the S3 at 7.2030. Let's put this in lime green. We rounded it up a little bit, taking out 2 peeps. And the second support line is being set at 72350. .2350. And the first support line right now is practically used. We used this throw here, where you see there how there have been repeated tests on this level, and it held its ground. So I'm thinking that's pretty valid. It's actually a very nice round figure. It's the S1 being set at 7.2590. Let's have a look at the resistance lines. First resistance line being set at 7 R1, 7.3100 in red. It's interesting how the latest throw and peak practically are near levels which are pretty rounded. The R2 being set at 73460. Let's also add the label here. It's, in my opinion, it's very, very important that you have a clear visual contact. At first glance, you can find where the resistance and support lines are, what's the direction. That should be visible for a trader with the opening of the chart. So if you're trading this pair on a more obvious, on a higher frequency, then it would be useful to have them ready. So on the one hand, we have an upward trend line which has been guiding the pair since the 2nd of January. Actually, the 1st of January here. 1st of January was closed, 2nd of January, since the start of the year. At the same time, though, we have to note that the pair has been moving upwards, however, at a stepped pace. You can see how there was an upward movement, stabilization, upward movement, stabilization, correction lower, upward movement, and we are now in the stage of a stabilization. For the bullish outlook to be maintained, I would require the pair to breach the 7.31 resistance line. I would be highlighting here that on the fundamental side, it's quite interesting in the following sense. We had disappointing rates and figures from Chinese financial releases. The GDP rate was disappointing for quarter two. The retail sales growth rate was disappointing for China. That was for June. And that tended to highlight the weakness of the internal demand side of the Chinese economy, and that it may not be able to actually support production side. We had also a slowdown of the industrial output growth rate. We had a slowdown of the urban investment growth rate. And we had another deeper contraction of the housing prices. All of that tends to cast a shadow over the outlook of the Chinese economy. It's no wonder that the PBOC on Monday, yesterday, in the Asian session, cut rates even by 10 basis points, which was minimal, but it did cut rates. And I think there is a strong effort on behalf of the Chinese to actually add more liquidity in the economy in order to boost economic activity. However, that remains to be seen. And all of that tends to weigh on the C and H, in my C and Y. And in my opinion, we are moving on a technical basis, maybe in a bearish triangle. It's a little bit far-fetched, I know it, but unless we see a clear breaking of the R1 7.31, there's no bullish effect here. It's on the contrary and remains confined, if you prefer, between the R1 and the S1. It's actually a very interesting chart. Okay, let's go and have a look at GBP/USD. Now, GBP/USD, let me readjust the chart a little bit, dropped broke the 1.2945 support line, now turned to resistance and stabilized below it. But the interesting element, or if you prefer, the important element, in my opinion, is not the breaking of the 1.2945 support line. It's the breaking of the upward channel which was guiding the pair, which was guiding cable since the 2nd of July. So practically all this upward movement has now been interrupted and the pair has stabilized. The RSI indicator remains pretty high despite correcting lower. It's at 60 point, let's have a look, 60.1. Now, the level as such more or less tends to imply that there's still a residue of a bullish sentiment among markets participants, which could push the pair higher. But for that to happen, the price action, or if you prefer for the bullish outlook to be renewed, the price action has to breach the 1.2945 resistance line, but also has to breach the R2 1.3043. Why? Because I would require the pair to have a higher peak than this one, with the ultimate target being now set at 1.3140 for the bulls. On the flip side, should the bears take over, we may see the price action dropping, breaching the S1 1.2835, despite actually the S1 being set as a former resistance line. It has now switched its role into a support line, given that the price action has moved above it, with the next possible target being pretty low. It's at 1.27. We're talking about 240 pips or so, 220 pips, which is, it may take some days for the pair to reach actually such a level. For the time being, we tend to maintain a bias for a sideways motion to continue, maybe with some slight bullish tendencies. But once again, for a bullish outlook, the R2 has to be broken, in my opinion. I'm a little bit conservative, I know it, but that's in my nature as an analyst mostly. Let's have a look at USD CAD. Okay. Another interesting chart in the sense that we have an intense upward motion practically for 1, 2, 3, 4, 5, 6, 7, 8, and this is the 9th day. Mind you that we had a small correction practically right here where the right candlestick is. That was on the 16th. Yeah, the 16th of July. But that's immaterial to the upward motion. What's material to the upward motion is the fact that it has reached the upper boundary of the past sideways motion, which is the 1.3780. Now, the big question here is, will the bulls be strong enough to actually breach that level and thus start paving the way for the 1.39? That's the main element which we will have to keep an eye out. The pair had reached this level once and twice, was aimed for here 3 times, but it failed to clearly break it. For a bullish outlook to be maintained, we need a clear break of the R1 and the price action to start aiming for the R2 1.39. Mind you that on a fundamental level, loony traders are now focusing on the release of BOC's interest rate decision tomorrow. The bank is expected to cut rates widely. It's characteristic that CAD OIS currently implies a probability of over 90% for such a scenario to materialize. However, CAD OIS tells us also another thing, and that's that the market is expecting the bank to proceed with another 2 rate cuts within the year. One, I think it's October, and one in December, with the December rate cut being marginal, meaning that the market is a little bit unsure on whether that will be happening or not. So, should the bank actually cut rates, okay, we may see some slight weakening of the Canadian dollar. On the flip side, let me rephrase that, should the bank in its accompanying letter show some hesitation, or if you prefer, should the bank in its accompanying letter actually show that it's prepared to cut rates even further, i.e. confirming the market's expectations, that could more or less amplify the bearish effect for the Canadian dollar. On the flip side, should the bank cut rates, but in its accompanying letter more or less imply that, guys, that was it, then I would expect the Canadian dollar to get substantial support here. For the time being, once again, we tend to maintain a bias for the sideways motion to continue between the 1.3780 and the 1.3610. That would mean that the pair will be hitting a ceiling at the R1, correcting lower, breaking the upward trend line guiding the pair for the past 9 days, and start aiming for the S1. For a bullish outlook, once again, I would require the pair to clearly breach above the 1.3780, something which is quite possible, given that we have an upward trend line, given that the RSI indicator is pretty high. It's right now at around, let's have a look, 64. It's nearing the reading of 70, implying a strong bullish sentiment among market participants for the pair. And should the R1 be broken, the way will be paved practically for the R2 1.39. Let's have a look at, do we have a look at the USD CHF? Oh yeah. USD CHF in a bearish triangle. It's interesting how the pair on Thursday bounced on the S1 0.8825, and I think that made it even more obvious that we're talking about a bearish triangle right here. Let me correct this just a bit right here. Now, the bearish triangle usually tends to identify the possibility of a continuation of the current trend, i.e. the downward motion. So, as a rule of thumb, however, that's definitely not certain, there's nothing certain in the markets, the pair is expected to obey the downward trend line and correct lower, breaking the S1 0.8825. However, that may take some time, days, maybe a week or so. Should the S1 be broken, then the bearish outlook will be confirmed, and the next possible target for the bears would be set at the 0.8725, a level that reversed the downward motion here, but also was used as a platform here and as a resistance line here. So that was pretty valid in the sense that it was tested more than once, and at the same time was tested both to the upside and the downside. Let's have a look at AUD USD. Sorry about that. Okay. Let's position this upon the resistance lines. Now, the main characteristic of AUD USD, this is the daily chart as always, was the intensification of the downward movement yesterday. It was very characteristic how practically the bears took charge, led the pair lower. We tend to maintain a bearish outlook for the pair, expected to breach at some point the S1 0.6570, a level that provided beautiful support here and was the lower boundary of the sideways motion of the pair right here. Allow me to draw a rectangle to highlight this. Right up until here. Anyways, so we expect the downward motion to continue, the S1 to be breached, with the next possible target for the bears being set at 0.6465. The RSI indicator is pretty low. It's actually at 37.55, which tends to highlight also the possibility of a downward motion. I wouldn't be surprised to see the price action actually being pushed lower by the bearish sentiment. It was a very steep drop of the RSI indicator, which tends to highlight exactly this intense bearish outlook. At this point, I would be also adding here the bulge bands, because I want to see how that would be affecting the price action. I would prefer the bulge bands in dark blue. Okay. The pair is nearing the lower Bollinger Band. You can see it right here. And should it reach it or breach it, then expect a possible correction higher. However, that correction will be just that, a correction, as long as the downward trend line remains intact. And I think that would be more obvious in the forward chart. Here you go. You had the peak, lower peak, and now it's intensifying. On the other hand, you have a true, lower true, and it's intensifying. More or less, I think that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So this week's webinar will be on multi-time frame trading strategies. And before we get started, just a risk warning as per usual. Our products are traded on margin and carry a high level of risk. And it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie Chong, and I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. So we're going to look at which time frame is the most important, how you can take a top-down approach, what you should look out for on the higher time frames, zooming into lower time frames, and then we'll look at how you can craft your strategy. Okay. Okay, let's get started. So firstly, before we get into everything, we're just going to do a really quick recap on the basics of trading. Okay, so firstly, we'll look at support and resistance. So it's basically the price at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So to identify these levels, you can use technical analysis tools such as trend lines, moving averages, chart patterns, or you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support and resistance. So we're gonna briefly look at this today, and then we'll get into I'll show you guys in a little bit why we're going through this before we get into the multiple time frames. Yeah, so it'll make more sense in the next slides. Okay, so I've added an image here for you to see how we can use swing highs and lows as resistance and support levels. So you want to take note of how there are clear peaks and troughs in the market structure, in order for them to be used as support and resistance levels. So let's first take a look at an incorrect example. So here's an example of insignificant swings, which are bad points to use for any kind of levels. So be it your support and resistance levels or starting points for your Fibonacci. Price movements over here are way too small and there are no significant swing highs or swing lows. Okay, so here's another incorrect example. So there aren't really any clear swing highs or lows and price movement is relatively small. Okay, so now here's a correct example of significant swings. So there's a really clear move up and down with obvious peaks and troughs and clear market movements. Here's another example. So I've drawn out the peaks and troughs to point out exactly how clear your charts should look like. Okay, so you can take these support and resistance levels as profit targets or stop loss levels, but you should not use it as an entry if there are no other supporting arguments such as Fibonacci or other graphical levels to support your analysis. Okay, because using a recent swing high or low is a weak level if that is the only level. Okay, so if there are at least two swing highs or low levels lining up nicely, then it's a much better level to use. So you want to try to find areas where these might line up. So it doesn't have to be exactly at the same level. So long as it's about a similar area, that's good enough. Okay, so one way to try and find these multiple swings is to try and see how far you can pull back your resistance or support levels. Okay, so as you can see in the GIF, it's okay to cut through these tiny wicks, but you typically would want to avoid cutting through the bodies of candlesticks. Okay, so now let's look at um, what other things to look out for when inputting a support or resistance level. Okay, so picking the starting point, you want to look for, or rather a pivot entry. You want to look for support or resistance levels, and there are a couple of rules. So firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Okay, so I mentioned earlier that we want to try and pull back the level as far as we can. Intersecting the wicks is preferred. You can refer to this image here. So you can see this green thumb is obviously that it's recommended, which means basically because it cuts through only the wicks of the candlesticks. These are okay because even though it does cut through only the wicks, it's not that preferred, because there isn't a very clear swing high or swing low over here. Okay, so preferably we want to look for intersections that we will see in the coming slides. So for example, here we have a red thumb here, and the reason for that is because it cuts through way too many bodies of the candlesticks. So you can see the green thumbs here cuts through just the wick of the candlestick, which is preferred. Okay, so just basically want to look for a nice clean cut and not something that's messy like this one here. Okay, so another example here, take note of this red highlighted area because you want to avoid intersecting so many candlesticks. Even though you might be able to argue that over here it's just the bodies, or rather it's just the wicks of the candlesticks, but it's way too messy over here. Okay. Okay. Next. So here's what a clear market structure looks like. Fibonacci retracements can be used in both choppy and trending markets, but it is important to look for a really clear market structure even before you get started on your actual analysis. Okay, so like for example here, this is an example of an unclear market structure. So you can see it's very messy, it's really difficult to conduct your analysis on. So this is typically something that you want to avoid. Okay. So which time frame is the most important? So one important thing that we can do to our analysis to adjust the time frames so that the market structure is clearer. So here we have an example of an unclear market structure. Okay, so this is on the 15-minute time frame, and you can see it's really messy. There's no clear movements in price. But if you change the time frame that we're looking at to 1 hour, this is what we have, and you can see the highlighted portion has much clearer movement. So it's way easier to conduct your analysis on the H1 instead of the M15. And both of these is on the same asset that we are analyzing. Okay, so there's two criterion that you should look out for. Firstly, a clear swing low or swing high. And secondly, a really clear trend as well between the starting and the ending point. Then your Fibonacci retracement or your analysis is more likely to be accurate. Okay, okay, so now let's look into um, a brief intro into our multi-time frame analysis. So now we've gone through what you should look out for and how you can kind of adjust your time frames so that your charts appear clearer. So let's look at what other things you can use with your multi-time frame analysis. So it basically involves analyzing the market from multiple time frames, and it can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select the time frame. Typically, traders will tend to choose at least two time frames. So that would probably be a shorter time frame and a longer time frame. The shorter time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall trend and market direction. So once the time frames are selected, the trader will then analyze the market from each time frame, looking for key support and resistance levels, trends, and patterns like we've done earlier. So for example, if the short-term trend is bullish and the longer term trend is also bullish, then it could indicate a strong uptrend in the market. So obviously, if you're a trader, this would be really helpful to make your trading decisions. So for example, um, if the short-term trend is bullish, then you might look into buying on dips or pullbacks in the market. Conversely, if the longer term trend is bearish, then you might look to sell or short the market. Okay, so it basically helps you to kind of zoom out and look at the bigger picture, analyzing trends and patterns from multiple time frames. Okay, so what should you look out for on the higher time frames? Firstly, we have the key graphical levels. So basically the horizontal levels that we looked at previously, how to identify your support and resistance levels, which is why we went through them before we started this. And then, of course, being able to identify your trends using trend lines and trend channels. Thirdly would be breakouts. So breakouts of these trend lines or trend channels or any of the support and resistance levels. Big moving averages, 50, 100, 200, golden cross or death cross. Ichimoku cloud also helps you to identify changes in trend or continuations in trend as well. And big Fibonacci levels that we mentioned earlier, such as your retracements, your extensions, projections, so on and so forth. And lastly would be price action. So price action basically is the past, present, and future. And you're trying to look at your momentum from the previous bar to dictate your strategy. Okay, so these are the different types of trading on the higher time frames. So for trend trading, it involves identifying and trading with the prevailing market trends. So traders would tend to enter positions in the direction of the dominant trend and hold them until the trend shows signs of reversal. This strategy often involves the use of technical analysis tools to identify and confirm trends. Next is swing trading. So, swing trading refers to capturing shorter term price swings within a larger trend. Traders tend to enter positions at swing highs or lows and take profits as the price moves in their favor. So, for swing trading, this strategy typically will involve holding your position for several days to several weeks, because you are trying to take advantage of the price oscillations. Okay, and then thirdly, breakout trading. So this involves entering positions when the um, price breaks through key support and resistance levels. So as a trader, you would tend to look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this for breakout trading, it involves a little bit more careful analysis and of price patterns and the volumes to confirm your breakouts. Okay, lastly, we have mean reversion trading. So this is based on the idea that prices tend to revert to their average or equilibrium levels after deviating from them. So traders would identify overbought or oversold conditions and take positions with the expectations that prices will eventually revert. So this would typically involve you using a couple of technical indicators, so like your RSI, your stochastics, in order to identify these potential reversals. Okay, so if we look at the lower time frames, there are also different kinds of trading methods. So firstly, we have scalping. So this is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they open and close multiple positions within a short period. And sometimes it could even be as little as seconds or minutes, um, as long as they catch small price differentials. So scalpers often rely on technical analysis indicators such as your moving averages or oscillators to identify short-term trading opportunities. For day trading, it involves opening and closing positions within the same day without holding positions overnight. So day traders would focus on intraday price movements, and they typically make multiple trades during the day. So they aim to take advantage of more short-term trends or volatility using technical analysis tools, chart patterns, real-time market data for trading decision making. Third, we have momentum trading. So this focuses more on capturing strong price movements that's driven by increased buying or selling pressure. So in order to do this, traders normally will look for stocks or assets that exhibit significant price momentum and then enter positions in the direction of the prevailing trend. So the kinds of tools or indicators that you would use would be something like your RSI or moving average convergence divergence or MACD to identify momentum opportunities. And lastly, we have news trading. So news trading involves taking advantage of significant market moves that result from news events or economic data releases. So traders will closely monitor the news, announcements, and enter positions based on the impact of the news on the market. So they aim to capitalize on the price volatility and rapid market reactions that occur immediately following news releases. Okay, so now that we know the different kinds of long-term and short-term trading, and we also know how to identify significant swings and use them as support and resistance levels, let's take a look at how you can craft your strategy, depending on, your lifestyle and what are the different kinds of time frames that you might choose. So starting off with scalping, this is obviously for a shorter time frame. So this kind of trading is fast-paced, it's exciting, and mind-rattling. And there's obviously short time periods between the opening and closing of a trade, but you grab very small amounts of pips. You're also risking a very small amount of pips as well. So it does depend on your own um, your risk tolerance. But it allows you to take advantage of market volatility and you're able to avoid known unknowns. So your locus of control, because you're looking at 20 pips versus a 200 pips. And there are new opportunities every time you open the chart. Okay, so the holding time tends to be from a few seconds to a few hours. If you are trading, what we typically recommend will be 1 hour in the morning, 1 hour in the afternoon, and 1 hour in the evening. But it is important to have proper risk management so that you don't need to monitor the trades all the way. Okay. Now let's look at the three powerful scalping strategies. Firstly, we have the horizontal pullback strategy. Then we have the Fibonacci retracement strategy. And lastly, the Nike tick strategy. So firstly, horizontal pullback. Basically, this is what we call pullback. So when price, so you can see firstly, there is this resistance. It's a swing high resistance with 3 swing highs. So you can see that price has broken out of this resistance level. It's surpassed it, but we're expecting it to pull back or retrace back to this level. That's why we call it a horizontal pullback strategy. So this is what we call a pullback support because we're expecting price to bounce off of this level. A pullback resistance is something like this. So you start off with a swing low support level, and then price breaks out of that support level, and we're expecting it to retrace back to that level. Okay, so if we're looking at an example on the charts, here we have an example with Ichimoku. So the Ichimoku cloud, how you typically would use it is if price is moving below the cloud, then it's an indicator that price is in a bearish momentum. But if price is moving above the cloud, then it is in a bullish momentum. So in this case, we have this swing low here, and price bounced off of it. It has broken out of it, surpassed it, And now we're expecting it to come back to that level. Okay, and you can see that's exactly what happened here. Okay, so now if we're looking at a Fibonacci retracement strategy, you should remember that your Fibonacci trend line must follow price structure clearly. Even though the trend line can deviate from price structure, it shouldn't deviate too much. So in the example that you see here in this GIF, you can see that the line that's been drawn, this orange line, it is basically the shape of price structure, but our Fibonacci trend line cuts through the entire shape. So this is something that we want to avoid. Okay, so if you're new to Fibonacci, and I have a couple of questions on that in the chat, I'll just show you guys this website that you can use. I think we've previously gone through the Fibonacci series on these webinars, but if you've missed that, not to worry, you can go ahead and look it up on theforexarmy.com. Okay, so yeah, that's theforexarmy.com, and then you can take a look at this trading guide, which is pretty comprehensive. It gives you a bunch of examples, some videos as well that you can watch. Yeah, so it's everything that we went through today, and it gives you a more in-depth understanding of how to use the different Fibonacci techniques. So like your retracements, how to draw them, what to look out for, how to find confluence areas as well. Yeah, so you can go ahead and take a look at that. If there's time at the end of my slides, I might briefly go through some of these techniques. Okay, but if not, yeah, you can just take a look at this website. Okay, let's get back to my slides. So the tool that we're using here is the Fibonacci retracement tool. And there are a couple of levels that we're looking out for. So here you can see we're looking out for the mid-range. So 23.6, 38.2, 50%, 61.8, and 78.6. Okay, but even though the tool is the Fibonacci retracement tool, it leads us to 3 different types of Fibonacci expansions. Okay, so firstly, we have a Fibonacci retracement plus pullback. So this is the pullback that we just talked about. You have 2 swing lows here, price has broken out of it, and we're expecting it to pull back to this level here. Okay, we also have this retracement. So take note of how closely this trend line follows the shape of the price structure. And over here, you can see our 61.8 lines up nicely with that pullback level. Okay, I also have another Fibonacci level. This is also a Fibonacci retracement. So it's from the upper swing high all the way to the lower swing high here, or swing low. Okay, so in this case, the 50% lines up nicely with that level. So we have two Fibonacci levels lining up with a pullback resistance. So we're expecting it to reverse off of this area here, which you can see is exactly what happened. Okay, if you're wondering why we chose this level as our I guess, as our support is because it's an overlap level, which basically means there is a swing high here and a couple of swing lows that line up in the same level. Okay, so that's why we are expecting price to be attracted to such areas. Okay, let me know in the chat if you guys have any questions as well. Next, let's look at this example, which is another Fibonacci retracement plus pullback, but this time we are also adding in a Ichimoku cloud. Okay, so here we have a descending trend line, but it's not exactly a valid trend line because it doesn't have, we need at least 3 touches on the trend line to be considered valid. You can see over here, we don't have that. Okay, so we're expecting price to bounce off of that level, off of the trend line again. We also have this Fibonacci retracement from the swing high to the swing low, and our 38.2 lines up at the area where we're expecting price to bounce off of. Okay, in this case, we are also using 2 indicators. Yeah, okay, let's look at this one first. The first indicator we're using is an Ichimoku. So you can see price is just about moving above the Ichimoku cloud, which is a bullish signal. Now, if we look at this slide, you can see our stochastic is giving us this hidden resistance level, which basically means that we're expecting price to also respect that area, like it did here. So you see we have one resistance level lining up with another over here. Even though price is making a lower high on our stochastic, it's remaining at this resistance level. So this is the second time that it's happened, and we're expecting it to happen again another time here, which you can see that's exactly what happened. Okay. Okay, so let's move on to our last strategy. So this is what we call a Nike tick strategy. So just to recap again, we have so many levels for 1, 2. Again, the tool we're using here is the Fibonacci retracement. So the Fibonacci retracement, we have the levels that are above 100, the mid-range levels, and the negatives. So the negatives we call Fibonacci expansions. But now for Nike tick strategy, we're going to look at the extensions. So for extensions are the levels that we use that are more than 100%. So that would be 127.2 and also 161.8. So here's an example. You can see the yellow arrows show us the shape of the Nike tick. So our starting point is over here, basically the head of the arrow or the shorter part of the tick. So you should make sure that price fully breaks out of this 100% before you go in and use this strategy. So our 161.8 is the projected level at which we are expecting price to reverse off of. Okay, you can see that's what happened here. That's basically what we are looking for. Any reversals off of either the 127.2 or like we see here, 161.8. Okay, so here is a GIF of what we are looking for and how it works. So we firstly want to see if it's going to break out of the 127.2 level. And if it doesn't, then we go in and expect there to be a reversal at the 161.8 instead. Okay. Okay. Um, let's move on. So for the Nike tick strategy, we typically would recommend these time frames. So the M30, H1, H4. Entry criteria would be if price breaks out of the 127.2. Okay, so we're using a stop loss at 145%, idea invalidation at 138%, break even would be 11% of the recent move, 50% take profit will be 11% of the recent move, and a full take profit is 22% of the recent move. Okay, so you can see the levels that we are using here. Um, the bonus we are also using all of these levels. So let me get into them now. So firstly, let's focus on the Nike tick. I think you guys can kind of get the idea now. You can see the shape of the tick. So we're looking at the 127.2%, which price has reversed off of. For the Fibonacci projection, we are looking at this level here. This shape rather, this flash kind of shape. And it's also 3 points. 3 points would be the starting point, middle point, and ending point. And you can see that we have a 100% lining up at that level. Okay, so the 100% lines up nicely with our 127.2. Okay, and that is our kind of our Fibonacci confluence area. So since we have two levels lining up, we call that a confluence area because it's more validation that price is likely to reverse off of that area. Next, Fibonacci expansion. Okay, no, we don't have that here. But why we mention support and resistance is because at this swing high, if you draw a horizontal line across, we're actually expecting price to bounce off and hit back to that level, which is why we have highlighted this arrow to hit back towards this area. Okay, so here's a long example instead. Again, you can see the shape of the Nike tick. In this case, it's an upside down tick, or rather an inverted Nike tick. So the head is from here, starting point here, ending point here, and the tail is here. So we're expecting price to bounce off here, and it did. So it bounced off this confluence area. Again, the confluence area is the 127.2 Fibonacci extension or Nike tick. And then we also have this 61.8% Fibonacci projection. So for the projection, just to recap again, the starting point here, middle point here, and ending point here. Okay, so it lines up and we can see price shot up after that. Okay, so another thing to maybe take note of is this minus is what we call our Fibonacci expansions. So for Fibonacci expansions, we're looking at these two numbers, the minus 27.2 and the minus 61.8. So you can use these levels as well to determine where we expect price to bounce off of next. After this reversal, you can see that there is this flash shape or lightning bolt shape. So it's very similar to your projection, which also uses a lightning bolt shape. So you can use these two Fibonacci techniques together, and you can see once price reversed here, we expect it to reverse off of the minus 61.8, which you can see it did. Okay. Okay, let me know if you guys have any questions. Okay, if not, I think we still have time to do a bit of live analysis. So you can let me know in the chat if there are any, oops, if there are any specific charts that you'd like me to go through. I think we might have time to just go through one. Okay, let's go through gold. Okay, can you guys see my charts? Okay, so on our weekly time frame, so like I mentioned earlier, we want to start off with our higher time frames and then work our way down to the lower time frames so that we get an idea of where prices are headed towards. So on our higher time frame, we can see this ascending, can definitely see price moving in this in an uptrend. Okay, so we're gonna see if we can find any ascending trend lines or trend channels to support that. Okay, I think I kind of can see, oh, can see this ascending trend channel. Okay, so what makes a valid trend channel is if there are at least two touches on top and two touches below. So let's look at our daily time frame now. Okay, and let's go in with some levels. Okay, so to start off, I think I have a Nike tick shape here. Okay, I'm gonna try and zoom in so that you guys can see. So the shape, the Nike tick shape is like this. Okay, and I can see that price is approaching my 161.8 level. So I'm gonna place a resistance level over there. This is my first resistance. My first support, I'm just gonna place it here at that swing high. Okay, so this is what we have on our daily time frame. So let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, you can see we have this swing high lining up nicely. And this is a resistance. Okay, I'm not sure if we have any Nike tick levels here since it's so small. Okay, no. If we take this Nike tick shape here as well, you can see the shape like this. Okay. Can see the 161.8 lines up with our first resistance as well. Okay, and I'm just gonna place our first support at this 127.2 level. Okay, next I'm gonna be looking um for some retracements. Also, this is my first support. And at this level, it's in line with this 38.2. Okay, so this is my second support level. Then I'll see if I can pull it back some more. Okay, so overall, we have a pretty bullish uptrend from our weekly as well as our daily timeframes. So we're expecting prices to continue to move upwards. So let's take a look at some indicators to support that. So I'd like to use Ichimoku and MACD first because at one glance you can see exactly what the signals are. So price is moving above Ichimoku cloud, so it's giving us a bullish signal. MACD is also giving us a bullish signal. If we look at Bollinger Bands, you can see it is also giving us a bullish signal. RSI. Actually, Bollinger Bands is not giving us a bullish signal. If I zoom in, it's not peaking above the upper band. So I'm gonna move this. If we look at our RSI, it is moving in the overbought area, which might be a signal that it's going to drop. So let's take a look at some other indicators. Let's look at stochastic. Okay, stochastic is moving in an ascending trend line, which could suggest that it's going to move higher as well. Okay, let's look at one more indicator. Okay, so MA cross recently occurred, okay, which suggests a change in trend. So over here, you see that price is kind of ranging in this area. Recently it crossed, which could suggest that it's going to move higher. Plus, prices are moving above both of the MAs, both of the moving averages. So it is still giving us a bullish signal. Okay, so I'm going to move my RSI because it doesn't support our analysis. Okay, so we're expecting it to continue to move higher towards our 161.8 and this swing high level here. Okay. Are there any questions? Okay, no worries. Okay, if there are no other questions or other requests, then I think that's all for today. Thank you so much for joining me, and I'll see you guys again next week. Thanks, everyone. What do you mean with toy? So basically, you click on this symbol, and let's say we are analyzing Euro USD, for example, right? And then, so depending on which broker you're looking at, click on it. And I like to start off with a clean chart. So it will look like this. If that's what you need. Time frames are over here. Indicators here. If you're talking about Ichimoku, or rather Fibonacci, the Fibonacci is this one. This is the retracement. So like this. This is the projection I was talking about earlier, which has 3 points like this. Um, oh, so for your support and resistance levels, I just basically use this tab here, this moving tab, which has these horizontal rays. And when you click on it, it's actually blank, but they do give you the option over here on this icon to choose whether, what you want to label it as. For indicators, we have starred these, but you can look up. There are so many indicators out there, so depending on what you are comfortable with, for example, maybe pivot points, we didn't star. So if I'm looking at pivot points, I might star this as well, and then it will show up in my favorites here. But you can just search it here in the search bar. Sample resistance 1, we have them preset. Okay, for example, this. Um, do you mean the template? Oop. Mm, oh, for indicators, you set favorites, for example, pivot points with this star here. Yeah, add to favorites, and then it'll show up in this column here. For this template, I'm actually not too sure. Oh, like this. Save drawing template as, and then you type resistance 1, resistance 2, save, and then I think it will show up here. Okay. You have any other questions? Okay, we'll see if we can do a full session on how to use TradingView. But yeah, thank you so much for joining me. Thank you for the questions. Have a great rest of your week, and I'll see you again next week. Thanks. Bye.